Analyze performance of cost centers, revenue centers, profit centers, and investment centers. Overview and objectives of responsibility centers. Responsibility centers are the fundamental building blocks of decentralized management control. Each center is a segment of the organization whose manager is accountable for specific financial outcomes and operational performance. The type of responsibility center determines what the manager controls and how performance is measured. Cost centers focus on efficient resource use, revenue centers on sales generation, profit centers on profit maximization, and investment centers on return from assets employed. This segregation allows performance evaluation to align accountability with decision authority. The objective is to enhance goal congruence, ensuring divisional managers act in the organization's best interest by measuring results against controllable factors. CIMA stresses that proper responsibility definition, consistent cost classification, and clear reporting relationships are prerequisites for effective divisional performance analysis. Cost centers, control and measurement. A cost center is responsible for incurring costs but not for generating revenues. Typical examples include production departments, maintenance, or administration. Performance is measured by cost efficiency, adherence to budgets, and variance analysis. Managers are accountable for controllable costs, those influenced by their decisions, such as labor efficiency or waste, but not for uncontrollable factors like depreciation or allocated head office costs. Cost variability analysis, fixed, variable, and semi-variable, supports realistic budgeting and performance comparison. Benchmarking and standard costing further enhance control by establishing expected performance standards. However, overemphasis on cost minimization can discourage innovation or quality improvement. Therefore, cost center evaluation must balance efficiency with effectiveness to prevent dysfunctional behavior that undermines organizational objectives. Revenue centers and sales performance. Revenue centers focus exclusively on generating income from sales or services, such as marketing or sales departments. The key performance metrics include sales volume, price realization, and customer acquisition costs. Managers in revenue centers are judged on controllable revenues rather than profitability, as they typically lack authority over product costs. Variance analysis, sales mix assessment, and customer profitability analysis provide insights into performance trends. Non-financial indicators, customer satisfaction, conversion rates, and market share complement quantitative measures to ensure sustainable revenue growth. CIMA emphasizes that revenue responsibility must align with controllable decisions. Otherwise, misjudging external factors like demand elasticity or competitive pricing can distort performance interpretation. Effective coordination between revenue and cost centers is essential for maintaining organizational balance. Profit centers, accountability for financial outcomes. A profit center combines responsibility for both revenues and costs, making the manager accountable for overall profitability. This structure encourages entrepreneurial decision-making within divisions. Measures such as contribution margin, controllable profit, and divisional net profit are used. The key distinction lies between controllable profit, reflecting decisions under managerial influence, and full divisional profit, which may include allocated overheads. Profit centers encourage internal competition and performance motivation but can create conflict if transfer pricing or cost allocations are perceived as unfair. CIMA recommends that interdivisional trading be governed by transparent transfer pricing policies to preserve goal congruence. Profit center evaluation also considers qualitative factors such as customer retention and operational innovation to ensure holistic performance management. Investment centers and return-based evaluation. Investment centers extend the profit center concept by including control over capital investment and asset utilization. Managers are assessed using financial ratios such as return on investment, ROI, residual income, ROI, or economic value added, EVA. ROI combines profitability and asset efficiency but can lead to short-termism if managers reject value-creating projects that lower the ratio temporarily. Residual income mitigates this by focusing on absolute wealth creation above the cost of capital. Performance assessment must account for both controllable investment decisions and uncontrollable corporate allocations. Non-financial metrics, innovation, asset productivity, and sustainability initiatives should complement financial indicators. Effective investment center management links strategic capital allocation with operational efficiency, ensuring that resources generate optimal long-term returns. Data analytics and contemporary performance management. The rise of data analytics transforms performance evaluation across responsibility centers. Big data enables real-time tracking of cost drivers, revenue trends, and capital utilization, enhancing decision quality. Advanced analytics tools allow managers to predict variances, identify inefficiencies, and optimize pricing or resource deployment. Balanced scorecard and dashboard reporting integrate financial and non-financial measures for a multidimensional view of performance. However, CIMA cautions that data quality, relevance, and interpretability remain critical. Managers must avoid data overload that obscures strategic insight. Modern responsibility center management thus relies on digital intelligence to link operational performance with strategic objectives, fostering transparency, accountability, and value creation across all organizational units.